Okay, so for interest, normally personal expenses are not deductible to individuals. There are some limited exceptions to that. Interest income, when it pertains to a home mortgage, is one of those exceptions. And when it pertains to investments. So even though these are for personal property, these are exceptions to that non-deductibility rule. So this is not all interest. It's only interest that is related to the acquisition or improvement of a personal residence, or up to two personal residences, up to two residences. So you can have two homes and deduct the interest from the mortgage on those homes. One would be your personal residence, whatever is classified as your personal residence. So that's, again, only on the debt that's incurred from purchasing that property or from improving it. Or also investment interest. So if you borrowed money in order to purchase some investment, then that investment, that interest, is deductible on the Schedule A as investment interest up to limits, up to certain limits. And we'll talk about what those limits are. So mortgage interest, so car interest, no, can't deduct any car interest. Can't deduct any credit card interest. There was a time when you could, before my day, but I think it was back in the 80s when they took that away, 1986 when that went away. But you could actually deduct interest on cars, and I think it was credit cards as well. Don't quote me on that, but now you cannot. It's only mortgage interest and investment interest. So we'll first talk about mortgage interest. And within that, they talk about home equity loans. So obviously interest, so if you're borrowing money, you are paying interest. It acts as kind of a fee in exchange for the privilege of borrowing that money. If it is paid for the acquisition or a home equity loan that is secured by the qualified residence, then the interest on that loan is deductible up to certain limits. So, and acquisition indebtedness means any debt incurred to acquire, construct, or substantially improve any qualified residence. So if you borrow money to get yourself a new kitchen in your house, that would be to substantially improve the qualified residence. That under certain limitations would be deductible. So suppose the taxpayer has a large unsecured personal line of credit with the local lending institution, borrows $35,000 to add another room. Does the interest on that $35,000 qualify? It does not qualify because it's a personal loan in this case. The personal loan is not secured by the residence. The debt has to be secured by the residence, which means they can take the house if you don't pay it. Okay, so it has to be secured by either the home equity loan or the first loan on that. So you can deduct interest on a principal residence and on a second residence, and you can choose. If you're lucky enough to have 6 or 7 houses, you can choose which house is classified as your second residence. But it cannot be the total amount treated as acquisition indebtedness cannot exceed $750,000 or $375,000 if you are married filing separately. So that means that your debt can't exceed that. The interest that is deductible can't apply to more than $750,000 of debt. That's actually this day and age, that's not as much as it used to be. Sounds like it's a lot of money, but there are a lot of people who, depending upon where you live, maybe not so much in the Midwest, but like those houses in California and urban areas that are really super expensive, even just ordinary houses costing over $1 million, it'd be really easy to have that much indebtedness. It doesn't mean you can't have that much debt on the house. It just means the interest is only partially deductible. That limit used to be $1 million, but it stopped, or it became $750,000 with the new tax law of 2017. So if a taxpayer refinances a loan, so for example, you have a loan for 6% and you want to get a lower interest rate, because now interest rates are 5% instead, and so you're actually going to be paying less in interest. So the new loan will qualify as long as it's still used to acquire the indebtedness, but you still got that. If the old loan was $1 million and it was before the 2017 law, then because of that 2017 law, the new loan will continue to qualify to the extent that the principal does not increase, and therefore the interest on the full $1 million is still deductible, as long as you didn't change that the principal amount of the loan. So here's an example of that, because I didn't say it very well. So Katrina and Marcus, married, they have debt of $580,000 to build a new personal residence. They decide to also build a vacation home at the beach, and they borrow an additional $200,000. Well, 580 plus 200 gets to 780, which is more than 750. So they've got too much loan for these two houses. They're going to have to apportion the interest that they pay on those loans, and the interest on the excess $30,000 is not going to be deductible to them. So they just have to do figure out the proportion of that loan that is deductible. So, but not all of the interest would be deductible. The vast majority of it would be, but not all of it. The amount of interest that's paid with regard to the $30,000 would not be deductible. So that applies so for unmarried co-owners, it applies on a per taxpayer, not a per residence basis. That means that individuals who own a home together but who are not married actually get a greater benefit. Each of them gets that $1 million or $750,000 limit, depending upon when the house was purchased. They get it separately. So you can actually buy twice as much house if you're not married than you could if you were married. So it's another marriage penalty that's kind of baked into the tax law there. So home equity interest. So a home equity loan is so you own a home and maybe you paid $200,000 for it, and it's now worth $300,000. So you have built up equity of $100,000 in that home, right? Because you owe the $200,000, but now it's increased in value. Now it's worth your equity increases either by an increase in value or by paying down the loan. That increases the equity. You can just think of the accounting equation when you're thinking about equity. So what people will do is they'll borrow against that equity. So now you've got $100,000 of access to capital that you can use then. If you do that, take out that $100,000 from the house, now you've got a $300,000 loan on the house, but that extra $100,000, if you use it to improve the home, it's deductible. If you use it to pay off your student loans or to buy a car or to invest in the stock market or whatever it is that you're going to do, then it would not be deductible. It's only going to be deductible if it's used to improve the home. So it has to be used in order to do that. So as long as the loan is used to buy, build, or substantially improve the taxpayer's home, that secures the loan. It's got to be, again, that home equity loan has to, if you don't pay the home equity loan, they take the house, right? And they take that house, not a different piece of property. So it's got to be, that property has to be secured by the loan. So the interest on the home equity loan for building an addition to an existing house would usually be deductible, but the interest on the same loan that was used to pay personal living expenses, such as credit card debts, is not. Under the prior law, before the 2017 law, the TCJA is the 2017 law that I'm referring to. The loan had to be secured by the taxpayer's main home or by a second home. It cannot exceed the cost of the home, and the loan also needs to meet some other requirements. So I'm not going to go through that example. Main home. Home equity loan and a home equity line of credit is really the same type of thing. A home equity loan is just a fixed loan. You take out a loan for $100,000. You have regular payments at one interest rate. It has a term, so you pay it off over 10 years, just like any other like fixed type of loan. A home equity line of credit usually has a variable interest rate. You can draw down funds, so they don't just give you the money up front. If you have a home equity line of credit, like say $100,000, you can choose to use it or choose not to use it. The interest rate usually varies. It may or may not have a limited term on it. So it's just kind of a continuing revolving, you borrow $2,000 from it and then you pay $1,000 off. And that means you've got that $1,000 to use again. So it's always kind of available. But it has the same, as far as the tax law goes, those interest requirements are the same. You still have to use it for improvement of the home improvement of the home. So here we've got Brian purchased a house several years ago for $130,000. Acquisition debt still outstanding is $115,000. So now he's got $15,000 of equity. But so see, he paid off $15,000. But now the value of the house has gone up to $150,000. So those are the two ways that your equity can increase. It can increase in value, and you could pay down the debt. So it increases the equity. So now the equity in the house is $35,000, $150,000 fair market value minus the $115,000 of debt. He could borrow up to $35,000. The interest would be deductible as long as he uses it for improving the property, and it's secured by the home. So another concept are called points, mortgage points. Sometimes when you purchase a house and you take out a mortgage, a loan on the house, oftentimes you're offered the opportunity to buy down the interest rate. So instead of, say, paying 6% interest over the course of the loan, you can pay a certain amount up front and you'll get 5% interest on that property. Usually they'll do a calculation for you to tell you how long you have to live in the house in order to make back what it is that you paid. So, for example, $100,000 house, and it's going to be a 6% interest rate, or you can pay what's called a point. A point is 1 percentage point on the house, so of the debt. So it's $100,000 debt. Say if it's 1 point, that means you're going to pay $1,000. You can pay $1,000 up front, and instead of a 6% interest rate, you now get a 5% interest rate. So you buy down that interest rate. You're paying money up front, but it's going to lower your monthly payments through a lower interest rate. Well, that point is considered to be prepaid interest. It's just interest that instead of paying it over time, you're going to pay it right now in order to get that discount in the interest rate. So because it's considered to be prepaid interest, it's still interest that you're paying, and that is deductible. When you purchase a home up front, you get to deduct, and you pay points, you get to deduct all of those points at once. So that $1,000 example that I just made, you would get to deduct $1,000 in points if you purchase the home. If you paid the points in order to refinance the house, so in order to maybe you're refinancing it. I mean, there's multiple reasons that people will refinance a home. If you're refinancing the house, so you already own the house you're just getting a different loan on the house, not another loan, but a different loan. You're exchanging loans on the house. In that case, what you have to do, the points, you don't get a deduction for it all up front. You have to spread out those points over the life of the loan. You have to amortize them. So if it's a 15-year loan, you amortize them, split it up over that all those points over 15 years. If you ultimately sell the house, you can then take the rest of the points at that point, at that juncture. But that's what mortgage points are. Usually they are reported on a 1098 form, the form that is used to report mortgage interest. If they're not there, they may be on that. They may be on that settlement statement. I had told you, remember, there's a settlement statement that when anybody purchases or sells a house or refinances a house, they'll have information on a settlement statement. Sometimes those points are there on the settlement statement. So that's what they're talking about here with points. Here's an example. We've got Jason and his spouse purchased a home in 2007 for $230,000. They borrowed $184,000 with a 30-year, 5.5% note. In 2024, they decided to make an addition to the house that would cost $75,000. They borrowed the $75,000, paid a 1% loan origination fee. So because it's a whole new, or it's a loan, this is kind of a different scenario than what I talked about, where it's not, this isn't really a refinance. This is kind of a home equity. They paid a 1% loan fee. They get to deduct $750 in points because it was in connection with the improvement of their principal residence. So if you take that out in order to improve, then you get to take it all at once. So it's initial, same facts, except the $75,000 addition, they decided to refinance their loan. So now their balance is at $175 because the interest rate was now 3.75% on a 30-year loan. Oftentimes that's why people will refinance if the interest rates go down. They had a 6%. That's what a lot of people are waiting for right now. Anybody who bought a home over the last couple of years, they are waiting for interest rates to go down so that they can refinance, because for a long time, home interest rates were super low. They were like between 2 and 3% on homes for several years. And then over the last, maybe 5 years or so, they kind of gradually went up. They went up as high as like 7%. So if you bought a home during that time, you're paying a huge interest rate. People are waiting for those interest rates to come back down again so they can refinance, because that will make a big difference to their monthly payments. So now the interest rate was 3.75%. They paid a 1% origination fee, but it cannot be fully deducted. Now, sometimes it's called an origination fee. Sometimes it's called points. As long as it's based on the value of the loan, it counts. If it's just a flat fee, it doesn't count, okay? So that $1,750 cannot be fully deducted this year because the new loan was not for the original purchase or improvement of the residence. All they did was they bought down that interest rate. So what they have to do is they have to spread that $1,750 over 30 years. Now, they're amortizing that, so they're going to get a whopping $58 a year deduction for the next 30 years. If, however, they sell it, like say they sell it in 2 years, then what they'll do is they can write off the rest of that $1,700, whatever they haven't taken, they can deduct. Not going to say anything about mortgage insurance premiums because they are no longer deductible. Investment interest. So that's mortgage interest before. Now investment interest. If you borrow money to finance the purchase of an investment, stocks, bonds, lands that's held strictly for investment. We're not talking about you take out a loan because to purchase a business and you're going to work in that business. That's not an investment. It's sort of an investment, but as far as the tax code is concerned, that's not investment property. That's under a different classification. So this is just simply investment. You're borrowing money to buy something that's going to essentially passive. You expect it to increase in value. That's how you're going to make money off of it. That's what you're anticipating. Interest expense is investment interest expense. It is Interest that is paid or accrued on indebtedness properly allocable to property held for investment. I think I just said that like in 3 different ways. So it is limited to the amount of investment income that year. So if you have $2,000 of investment interest expense, I just want to make sure this is on. Yep. Investment interest expense, but you only had $1,000 of investment income during the year, and that's from like interest, stocks, bonds. It doesn't have to be from the same investment, right? But it's just investment income. Then you're going to be limited to $1,000 of investment interest expense. So you cannot deduct more in investment interest expense than what you had in investment income during that year. Does that make sense? It's limited. So again, you got to compare, what did I have in investment income? What did I pay in investment income or investment interest? And I'm going to be limited to what my investment income is. So whatever is lower of those two. So here's an example. Gail purchased a tract of land that she felt would substantially appreciate, gain in value, over the next several years. She borrowed $20,000, signed a 5% 15-year note on it. Her only investment income is interest of $1,000. She could deduct the interest on the lending institution loan up to a maximum of $1,000 in the current year. Any remaining amount of interest would be carried forward to future years and be deducted when additional net investment income becomes available. So it doesn't just go away. You have to wait until you have more investment income to use it to offset that. So some of the things that qualify as investment income: interest, dividends, short-term capital gains, gains and losses from the disposition of investment properties must first be netted, yada, yada. We're going to go through all of that stuff actually in chapter 7. You're going to love it. I'm joking. It's the netting of capital gains is one of those brain explosion kind of moments. So let's see, what else do I want to say here? Nothing really. So the big thing I want you to take away from this investment income is that it's limited, or investment interest expenses, it's limited to the amount of investment income that year if you then have any left over. So for example, let's say you have interest, let's see. So here's your income. Here, interest of $1,000, dividends of $500, and some capital gains, short-term capital gains of $500. So your total investment income is $2,000, but you have you paid interest on a loan to buy whatever it is that's giving you this $1,000 of interest. So your expense, investment expense is $2,500. So this is $2,500 here. The only thing you can deduct, you're going to deduct this year. And then you're going to carry forward. Well, I should do it over here. So $2,000, deduct this year. $500, carry forward into the future, so that when you have other investment income, then you can deduct that $500 from it. So then you can use it. Again, this is all assuming that you are itemizing your deductions, which, again, most people don't. So let's see. Those are the types of interest income. This is what a mortgage statement looks like. It's called a 1098 form. See it up there? Mortgage interest is listed here, how much was paid during the year. Sometimes they'll say how much principal is left, so what's left to be paid on the loan. Mortgage origination date, when did it start? Again, that's not necessarily when you bought it, but when you started the mortgage. So when you took out the loan. Points paid on purchase of personal residence. So if you paid points when you bought the residence, it would be listed there, but that would only be listed in the current year if you bought it in the current year. Like next year, that wouldn't be listed on this 1098. You get one of these every year that you own, that you have the mortgage. Address, description of the property that's securing the mortgage. That's important because sometimes people have multiple residences, especially like rental properties. People will have like multiple rental properties, and then you're trying to match up. And by the way, rental properties would go on a different form, not going on here. This is just personal, related to personally owned property. We're going to talk about rentals in chapter 8. Okay, so that's kind of a separate type of separate type of income. But this address where the property is located is important when you've got multiple homes and you've got to match up the expenses with that particular home. So, what else do I want to say? I think that's about it. Any questions? All right. You guys are